I would say that the Fed may actually cut rates sooner than Michael Wilson expects, and maybe sooner than a lot of Wall Street expects. And you say, well, Jim, isn't that good for stocks? And the answer is no, because the reason they're going to cut rates is because things are going to be much worse than even Wilson and others expect, which is going to cause the economy to crash. And then you will pivot, not because you want to, but because inflation might be zero, it could be negative. We could actually be into deflation. We're already in disinflation. Disinflation is when you still have inflation, but it's coming down. That's disinflation. It's still coming, you still have inflation, but it's coming down. Deflation is when prices actually go down. Inflation is negative. It's not a question of going up at a slower rate. It's a question of actually going down. And then that feeds on itself. That's a central banker's worst nightmare, because people say, why should I buy anything? I'll just sit in my money and wait for the price to come down, maybe buy 6 months from now, or maybe wait a year. And then that feeds on itself. And then unemployment goes up, businesses shut down, stock markets crash, et cetera. And the Fed pretty quickly turns around and cuts rates. Now, we've actually seen this movie, and it wasn't that long ago. Go back to 2015, December 2015. That was the famous liftoff. Remember, interest rates had been at zero, I believe, for six and a half years at that point, the zero interest rate policy. And then Janet Yellen raises interest rates 25 basis points. Okay, it was a baby step, but at least they went up for the first time in 6 or 7 years. And actually, it was longer than that, because they were at zero for 6 years, but there was a series of cuts to get to zero. So the last time they had raised rates was even further back. That was like 2006. So that was more like 9 years. So she raises interest rates 25 basis points and then waits a year. The next rate hike was December 2016. They waited a whole year just to go 25 basis points more, almost as if they would have been embarrassed if they had done nothing in all of 2016. I think it was the only reason they did it. But then when Powell came in 2017, that tempo picked up. It was like kind of nothing burger for a year and a half. But then Powell's like boom, 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 25 basis point hikes, and got the rate all the way up to 2.5, which doesn't sound like a lot, but considering that they had been at zero for 6 years, that was pretty steep. But what happened between October 1st and December 24th, 2018? The stock market collapsed. I mean, the Dow Jones, the S&P, and the NASDAQ all fell about 20%, just short of a bear market. It was like 19.8%, 20% to all intents and purposes. But that was in less than 3 months. And the Fed kept raising rates in the middle of the stock market crash. This shows you how out of touch they are and how behind the curve they are. So the last rate hike was December 14th or 15th. They got to look at the calendar. It was right around the middle of December, 14th or 15th. Even after 2 months of crashing stock prices, they raised rates one last time. They just kept going, and kind of what we were talking about earlier. And then finally on December 24th, what I call the Christmas Eve massacre, the NASDAQ fell 3% in one day. The Dow was like about 1.8%, S&P was over 2%, and the NASDAQ was 3%. And then the Fed got religion, like, oh, we went too far. We're the last to know, as always. So early January 2019, Powell said, use the word patient. It's one of those code words. It means, patient means we're not going to raise rates unless we tell you. So they were on pause. And then by late 2019, they cut rates. And then along came COVID. And by March 2020, they were back to zero. You had this huge round trip from zero in November 2015 to about 2.25, 2.5 in DC 2018, back down to zero by March 2020. And what was that all about? Well, the Fed went too far, didn't know what they were doing. The economy was weaker than they expected, and they raised rates. So bring that scenario forward to today. I feel like I'm watching the same movie, which is, okay, the Feds, they got the gumption, they raise rates. Now they're much higher than they were in 2018, but they're flying into a hurricane. They're flying into a very weak economy, seen by a lot of metrics: housing starts, global trade, ISM surveys, industrial output, inventories. There's tons of negative data. It's not the kind of thing that people doesn't make the headlines the way CPI does, but it's all there. It's hard data. So it looks like a bigger, better version of what happened in 2018. I would expect a worse outcome. So my point is the Fed may in fact cut rates sooner than Wall Street expects, sooner than Michael Wilson expects, but not for good reasons, but for very bad reasons, because we're in a severe recession. So the bottom line is we've had the supply side inflation. Now, we have not seen it come from the demand side, but let's say you're the Fed, okay? All you want to do is get inflation under control. You kind of don't care where it's coming from. You just want to get it down to 2%. So then the question is, okay, how is the Fed doing at getting inflation to the target? The 2% we talked about, and we explained why that's their number. The answer is they're making progress, but they're not there yet. And this says a lot about what's going on in the stock market right now, because you go all the way back to August 26, 2022. That was Jay Powell's Jackson Hole speech. And he said, inflation's, he didn't use the word out of control, but he said inflation's way too high. We're going to bring it down to our 2% target. We know unemployment's going to go up. We know we'll probably have recession. He did not use the R word. He didn't say recession, but he said, growth will suffer, unemployment will go up. That's just a fancy way of saying there's going to be a recession. And we're not going to stop until we get there. And so, in other words, too bad, Well, the Fed has no tools to affect the supply side. The Fed doesn't drive trucks. They don't drill for oil. They don't plant crops. They don't run tractors. They don't do anything that could alleviate the supply side problems. All the Fed can do is destroy demand, and that they can do. When you raise interest rates enough, mortgage rates go up, credit card rates go up, costs of working capital go up. All that tends to slow the economy, and it causes people to tighten their belts. But just think of the conundrum. The inflation is coming from the supply side. The Fed can't do anything about the supply side, but they can crush demand, which should reduce inflation. But how much do you have to crush demand when that's not the problem? It's coming from the supply side. How much demand do you have to destroy to actually affect the supply side? The answer is a lot. This is what Jay Powell has been saying. Unemployment has to go up. We're going to be in a recession. We got to crush this thing before it gets out of control. And you got to crush it even more, because that's not even where the inflation is coming from. It's coming from the supply side. Supply chain bottlenecks have been alleviated to some extent, not completely by any means. And it was always a case of popping up here and there. It's not like you went into a supermarket and all the shelves were bare. It wasn't East Germany in the 1950s. But something would be missing. It could be the peanut butter one day, or the canned goods the next, or spaghetti the week after that. That has alleviated to some extent, not completely. But again, the reason it has been alleviated is a very bad one, which is that demand is down. In other words, the Fed is destroying demand, so people are buying less. So, grocers and retailers and boutiques and suppliers are able to keep more things on the shelf, not because all the logistics problems have been solved, but because the demand is down, because that's what the Fed's doing. So supply chain better, yes, but for good reasons or bad reasons? Well, it's for bad reasons, because demand is down. And that's another thing leading us into a recession.